Good morning. My name is Pierre Baudot. I was born in Paris and I am based in London. So today we'll speak about investing in art or art as an asset class. Just as a disclaimer, oops. So my family has been collecting art for a very long time, and my father is an art dealer specialized in rare stamps, old letters, and historical documents. I also run a family office to manage the wealth of some very wealthy families in London. So we are a uniquely qualified team of art advisors. We have some of the top 5 experts in various sectors of the art market, whether it's paintings from the Old Masters, 19th century, or Impressionist, post-war, modern art, and some contemporary art. We also collect or advise on Chinese porcelain, Chinese art, as well as sculpture like Rodin, Degas, and Claudel. And we have created a sophisticated proposition for investors, which is transparent. So let's start with a small game. Which one do you think is the most expensive Chinese porcelain? Is it A or B? So those who think it's A, please raise the hand. All right. Don't be shy, you know. If you think it's B, raise the hand. All right. Well, the good news is you all have good taste because they are both expensive. So it's A. So we bought it for $5,000, and it's worth about 100 times more. It was a discovery in an auction because it was not catalogued properly. And B is a good one. B is a good one because it's depicting a Dutch delegation paying tribute to the Chinese government. It's very refined porcelain, well made. It's a good subject. But the reason why A is so unique is because it's a porcelain which is depicting the making of porcelain. So that makes it very rare subject. So some people told me, well, it should have been A because it's a beautiful porcelain, the small details are better than the B. So let's take a Chinese bowl whose details don't seem that great. So do you think it's a Chinese bowl which is worth 10 pounds, and if it drops on the floor you just don't care? Or you think it's a very nice one? So how much do you think it's worth, this one? Yeah, why not? Yeah. Okay, so how much would it be? 5,000, 500, 50,000, 1 million? Okay, not far, not far. It's, oops. Oh, it's written already? Ah, you know, it's too sensitive then, okay. Okay, it's a good one. All right, so let's go on some quantitative data. So we've seen that in the past decades, sales at public auction houses like Christie's, Sotheby's have literally boomed. The market is 4 times bigger as it was in the past. However, those sales of $15 billion exchanged at auction houses represent only those publicly available data. More than half of sales actually occur privately through dealers or art advisors. So the market is in fact about $30 billion. Now, is it a lot or not? The stock of artworks, if we exclude the major public museums, is about $3,000 billion. So only 1% of the artworks collected in the world are traded every year. So that means that most people either bought bad artworks or they really love them, so they keep them and they never really sell. Now, we see that 5-6 years ago, China represented a very small part of the world's art market, but today, in 2014, it represents about 30-35% of the world's market. The Middle East has its stake, but it's I would say, a growing market, but still not very small. However, the collectors have very nice collections. In the Chinese market, we often have, if you read financial newspapers or art newspapers, they always mention the new breaking record of a $100 million Chinese painter. But in fact, those contemporary Chinese art represent only 10% of the market in China and in Hong Kong. Most of the market is more traditional calligraphy, old paintings, as well as Chinese porcelain. So when you compare an art index measuring the price variation throughout the past decade, when we compare that price index for art to some major stock indices like the FTSE in London and the S&P 500 in the States, we see that art has been a bit less volatile, but most importantly, it's performed better. Now, the caveat to that is that art is not a single market, but a collection of niche markets, and each niche market has performed differently. All right, that's a bit dry, this slide, but it's the most important one for investing. So why would you diversify your portfolio into art if it doesn't provide you any benefits for diversification? So here, the lower the coefficient of correlation is comprised between -1 and +1. So when it's, for example, 0.5, that means art moves by 0.5 when a stock index moves by 1. So that means it moves less. If it's 0.8, that means it moves almost as much, so there is no benefit for smoothing the price variation in your portfolio. Now, conversely, if it's 0.2, or even better, minus something, then that means that will reduce the price variation in your portfolio, and therefore it's good to include art in your portfolio to diversify your assets. So how do people consider art? Well, typically in my family office for clients, they have investments in real estate, 20%, in equity, 35%, in fixed income bonds, 30%, cash, they have a bit of cash, but it doesn't produce any interest. And some clients who are not necessarily collectors, they could put 1 to 5% in art. Some of it for pleasure, collecting, so you can collect contemporary art, for example, and some for investing, and we'll see that later. So when you want to produce short-term returns, so higher returns, typically you would consider some contemporary art, some Chinese porcelain, some Chinese imperial porcelain. The difference between export and imperial is export porcelain was porcelain made by the Chinese for the Western market, so typically the Europeans, while the imperial porcelain was made by the Chinese for the Chinese emperor. Other Asian art, some sculpture, and some rare stamps. The reason why we include rare stamps is not only because my father is a stamp dealer, but also because when we buy a collection, we sell half of it in 3-4 months. So it's quite liquid. Now, if you are looking for a longer holding period, like 5 years, 7 years, 10 years, you may want to include safer, less volatile segments of the art market. So typically, you will want to have some old masters. You will want to have some impressionists that have passed the test of time. So you know these are blue chip, high quality artworks. And you will include some post-war. Now, for such a portfolio, if you want to buy blue chip impressionists, you can't buy them with $1 million. So you need to have a big portfolio for that. So how to invest in art? Well, the art fair is about contemporary art, so I put some contemporary art. Now, the contemporary art market is divided into mainly the primary market, which means that the artwork is sold for the first time to the market. And the secondary market is when the artwork has already been sold after you sell it to a second person. So for some emerging artists, there is no secondary market because it's the first time they sell and you don't know if the value will hold, if other people will be interested in the person who bought it. So they're actually more risky than the secondary market. Now, if you consider previous periods of the art history, the artworks have a track record of prices, so therefore they are less risky because you have a better idea of what you're buying in terms of quality and price stability. So you have a couple of different strategies that I listed. One is what typically collectors they do. So they buy at an auction house or at a dealership because they like it or because they think the price will go up, and they hold it for many, many years. But when they buy it at what it is worth to them, more or less the market price. Now, when you're a dealer, an art dealer, the collector didn't need the money to buy he had money to buy the art, but the art dealer needs to make money out of it. So if he buys an artwork, he can't pay the existing market price. He has to buy much lower, otherwise he won't make a living out of it, and he won't be able to pay the costs. So the dealers typically, they do short-term arbitrage, which stands for short-term risk-free profit. So if an artwork is worth, I don't know, $100,000, they will want to buy it $50,000 and then sell it to market price to their clients. They won't sell it much more because the goal is to make your clients happy. So you want to keep them in line with the market price. And the difference, either you bought it with your own money or you had investors' money, and then you can split the profit. Another way is to lend money against artworks. So there is a lot of old European families that don't have cash. They have a lot of assets. And in order to pay their expenses, they want to borrow against their artwork. So some banks will lend against the artworks. So for example, you have, and I'm not working for them, you have Deutsche Bank that will lend money against artworks. But that's a way for them to differentiate from other banks and as clients to bring other financial assets and become a client. So let's try to see how short-term arbitrage work, because these produce the highest returns. So let's look at two different scenarios. What happens for a collector and what happens for a dealer. So they both have the same amount to invest, 100, but they're going to have different strategies. The collector, he buys it. Often he's going to put it on his walls, sometimes in a storage, and he's going to wait for a number of years to appreciate, and when it's the right time, he will sell it. So when he buys at 100, the artwork at that time he bought it was worth 100. The dealer, when he has 100 to invest, the artwork needs to be worth at least 150. Now, the collector will have to bear a number of costs. If he buys at auction, there will be a buyer's premium, and then when he sells, there might be a seller's premium or not, depending on the price of the artwork and if it's a big client, but often there is one. And there will be a number of holding costs like insurance, storage, etc. So, and he will hold it for 5 to 10 years. So the sale price, if the market increases at 5-6% per year, will be 160. The dealer, he wants to sell it as quickly as possible because the artwork was worth 150 and he bought it 100. So if he sells it the next day, he makes 50 profit. Now, it's not as liquid as a stock where you press the button and in the stock exchange you sell the artworks might take weeks, months, or years to sell, but good dealers on average, they turn around their stock in about 2 years. So in that case, the sale price is 150 like we saw, and the net profit will be 23 in both cases. So you can see here that the return is only 4% net for the collector, while for the dealer it's 11%. So for the dealer here, I've been very conservative because when you buy artworks that are between $5,000 and a few $100,000, you can sometimes have even higher return. So here I just restating what we said. You know, the collectors, they have a traditional buy and hold. Now they call that investing, but actually what happens when a collector goes to an art gallery? He thinks he's advised by the gallery, but in fact there is a conflict of interest here because not only by law, but when you look at what really happens, the dealer, either he's selling on behalf of someone the artwork and he's paid by the seller, so he cannot advise the buyer. You can't be on both sides of a transaction. Or the dealer bought the artwork with his own money. Therefore, he's representing himself and not the buyer. So in fact, the collector, even if he's a multi-billionaire and he has a good taste, he's very intelligent, he's passionate, he's maybe even more intelligent than the art dealer, but when he buys the artwork, in fact, he's paying the profits to the seller, who can be the dealer or the client of the dealer. Well, I mean, here I just don't need to comment on that. So, what do you need to consider when you invest in art? I mean, the first thing which is critical is you want to buy art because you love it, or because you want to make money, or because you want to do both. That's very important. Some of my clients, they don't care about making money. Some, they just buy because it's a good deal and they put it in storage, and some, they even fund us. So they give us money, they never see the artwork, and we trade artworks on their behalf like we would be trading stocks or high-tech companies or other things. The next important one is the transparency. So it's a market which is unregulated. It's not transparent at all. Usually sellers don't know buyers. And that leaves room for a number of ugly little things that happen quite often. If the seller doesn't know the buyer, the dealer can say, well, we sold the painting for $6 million, while in fact they sold it for 7 or even more, and they keep a hidden commission. So there's a famous case like that in London with one of the top art dealers who is advising the Queen, and they kept a hidden commission. And I think that's more frequent than it's stated. The other important thing in transparency is to know the conflict of interest, who the dealer is representing, himself, the seller, or the buyer. Then the liquidity is very important. If you need your money, don't invest in Allmasters because you can't sell them quickly. Just rather invest in stocks or in money market funds. The reputation is very important for the dealer. So it's not only a question of having a good eye, which is very important. It's a matter of doing the due diligence very well. We'll see that later. And you need, of course, to know what's the price you should acquire the artwork for. Now, in addition to that, you should consider 4 other points. Structuring, because when you invest money in art, do you want to buy under your own name? Do you want to buy through your trust? Do you want to buy through an investment company? Do you want to buy through a private fund? Do you want to buy with a couple of friends and pool your money with them? Do you want it to be, I think here it's tax-free, but I'm based in London, it's not tax-free. So you need to have offshore vehicles, but they need to be run properly with trustees, and it's an additional cost, so it depends, it's something to take into account. Do you want to keep the artworks at home? Do you want to lend them to museum? Who is it going to be the art dealer who is going to, thank you, keep them? Another point is also taxation. So there is lots of taxes to take into account. It's possible to avoid almost all of them. In Europe, we pay the VAT. Well, Madame is laughing, but no, but to avoid all of them in a legal way, of course, you know. And in a way where you're going to sleep well and not be challenged by the taxman, of course. So the first one for VAT is if you sell an artwork, if you're in London and you sell an artwork to someone else in the EU, for example, VAT will apply. But if you sell to someone in the Middle East, VAT is not applied. Now, if an artwork comes to Europe from outside Europe, you have import VAT, which varies from country to country. And if you have those highest returns, which is short-term arbitrage, that triggers income tax because it's trading, versus if you have a very long holding period, that's more about capital gains taxes. And usually in most countries, capital gains tax are lower, but what matters is not how much tax you may want to pay, it's what is the net profit after all the expenses and taxes. So for valuation, so how do you value an artwork? I should have asked the question before, but so, I mean, there are a number of criteria. The first one is authenticity. No one wants to buy a fake. The second one is attribution. So I give you an example. Is the Allmaster Rubens, or is it another painter? And is it really a Rubens? It could be Rubens and studio, or studio of Rubens. And the price varies dramatically. So a Rubens could be worth $20 million. That means Rubens supervised it, did it himself, 100%. But if it's Rubens and studio, okay, he was busy, he directed it, he did some parts, but his students did a lot of it. And if it's studio Rubens, he never supervised it, he never did anything, and in that case, it's not worth 20 million, but 50K, 80K maximum. So I have a lot of very wealthy clients or potential clients who contact me, say, Pierre, you don't like my Rubens, but this is not a Rubens. So now I have learned how to deal with emotions of clients. I just say I'm not interested, so that you don't give any reason. The third one is condition. An artwork which is in a bad condition, if it's difficult to restore it, if you buy it when it's in bad condition, you may want to restore it, but it may never be in its initial condition. So be careful not to overpay. Rarity, everything which is rare commands a premium. Historical importance. Provenance is critical for 2 reasons. The first one is obviously you don't want to buy any artwork which is stolen, so you need to know from whom it comes. And the second one is that some provenance are very prestigious. So for example, if it stayed in a famous family or royal family for 30 years, 50 years, and it was almost never shown, it's quite exciting when it's for sale at an auction. Past exhibitions to enhance the value of artworks in museums. the size, the medium, the subject matter. I remember that client who didn't want that portrait of a not very beautiful English countess, and he didn't want to put it in his bedroom when he's with his wife. So he said, I know it's half price, but I don't want to buy it, you know. So it's more difficult to sell than if it's a nice landscape or a beautiful seaside portrait or whatever. So the subject matter, the fashion is important, and the quality sometimes becomes the first criteria. Usually bigger paintings come at higher prices, but it's not always true. You have portraits of Queen Elizabeth, which are big, quite nice, but not perfectly executed, and you can have a tiny one, which is perfectly executed in pristine condition, that is so amazing that you feel good when you see it, and instead of selling it, I don't know, 85,000 pounds like one was sold recently, this one is for sale for 600,000 pounds. And then you have some criteria that have nothing to do with the quality of the artwork. It's more the market condition. So if you invest in contemporary art, but the stock market plummets, goes down, often who buys the contemporary art? Hedge fund managers in New York, in London. And you know, obviously, when the markets are down, they don't get paid their bonus. Then they don't have money to buy the contemporary art. They may even want to sell their art because some of them have debt. They bought a too big house. They have too many cars, and they need to sell. So the price is further depreciated. But if you buy Old Masters or some Impressionists, it's less volatile. Also, the exit strategy is important. How you're going to sell your painting will have an impact on how much you should pay for it. When you deal with contemporary art, the authenticity is not really an issue because the artist is often alive. So you can ask or you buy directly from him. So you know it's not a fake. When you're on the secondary market for contemporary art, you need to ask for the certificate. The attribution, obviously, that's the same thing with the artist. The condition, unless you didn't take care of your painting, it should be good. And the provenance is easier to study than when it's 100. It's been through different people over 100 years. So just as a summary, why would you invest in art? The first one is a tangible asset. You can touch it. So it's not like a stock or a bond, which is a piece of paper. And if you choose well, high quality artwork, it will be investment grade, so it's a safe haven. Obviously, these assets are portable. So I know that in the Middle East you love real estate. We love it also in France, don't worry, or in England. But the houses are not portable. So if the British pound goes down when you buy a property in London, well, the price of the value of the property will go down, while a painting which you bought in London, you can sell it in New York in dollars, and it will be a good currency hedge. Also, your assets will not be frozen. I have some clients who are Russians, so if we put them in some countries where there is no agreement with the States or Great Britain, then it's easier for us to not have the assets seized. Diversification, like we saw, nobody wants to put their assets, their eggs in the same basket, and also you want to reduce the volatility of your portfolio. Inflation hedge, because it's a real asset. Over time, there is inflation, price increase for food, for real estate, for maybe not oil all the time, but over a long term it does. So for art, it's the same. Now, you can access the proprietary trading of some dealers, like we say. So basically, it consists of what I said before. You don't get the artwork. You fund the dealers with the money. They buy stock at a big discounted price. They sell it to market price, and you share profit 50-50. This is actually a Sharia-compliant way of doing investments. And you have wealth preservation, which can be achieved in different ways. You can buy and hold, keep it at home, or you can put it in a storage. And that's it. That's my disclaimer as a family office. You know, that's the legal stuff. So, questions?